The increase that you've seen in the gold price in the absence of any retail buying in Western Europe and North America is testimony to the fact that global central banks, reacting to the weaponization of the US dollar and not trusting each other on Monday to fulfill their obligations on Tuesday, are seeing that they have no alternative but to increase their gold holdings, both as a store of value and as a medium of exchange.
The recent surge in gold prices has captured the attention of investors worldwide, driven not only by the uncertain economic climate, but also by the remarkable price trends in the precious metal. The spot price of gold reached a new high, soaring to nearly $2,200 per troy ounce after days of consistent growth. This surge marks an 8% increase from the previous record high of $2,135 recorded in December 2023. Central to this uptrend is the strategic response of central banks to the weaponization of the US dollar and the growing concerns over currency volatility. In his analysis, RickRule emphasizes the heightened gold reserves of central banks as a hedge against these risks. This strategy has been particularly evident in the accumulation of gold reserves over the past year, driven primarily by China, Germany, and Turkey. These countries have led a global effort to safeguard assets amid the challenges posed by the current state of the US dollar. In parallel, 2024 has witnessed the second highest February wholesale gold demand since 2017, remaining consistently above its 10-year average of 118 tons. This surge in demand underscores the widespread recognition of gold as a crucial diversification strategy in the face of currency fluctuations and economic uncertainties. Moreover, there is a notable shift in global trade dynamics, with signs of diminishing US dollar dominance. Even the European Union has expressed a desire to reduce reliance on the dollar, as evidenced by the German foreign minister's call for a new EU-based payment system independent of the US and the SWIFT payment system, focusing on minimizing dollar transactions. RickRule's analysis concurs that while the US dollar's dominance in global trade is declining, it remains indispensable due to the liquidity and reliability of its debt market. Now we present the clips of RickRule's insights from his recent interview with Liberty and Finance. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
I do agree that the US dollar is becoming a less important trade mechanism than it was, but its former market share was 100%. And while we are doing our very best as a country to wreck our currency, we're thus far unsuccessful because as idiotic as we are, we seem to be smarter than the foreigners. It is true that the Russians and the Saudis and the Persians and the Chinese and the Brazilians and the South Africans and all of these people are tired of being lectured by the morons in Washington. It is also true that the weaponization of the US dollar has meant that increasingly people whose policies are at odds to American policies want to find exchange mechanisms outside the US dollar. My experience has been doing business internationally for 40 years. As much as they distrust us, they trust us more than they trust each other. And I would suspect that fears of, as an example, the BRICS currency, eclipsing the US currency in my lifetime, I'm a very healthy 71-year-old, are very, very, very overblown. The liquidity and the transparency and the depth of the US dollar debt market is so deep that my suspicion is whether other people like it or not, they're going to use it. Will the Russians occasionally settle an oil and gas sale in Chinese renminbi? Yes, to the extent that they could turn around and spend that renminbi. Will the Russians acquire substantial amounts of renminbi denominated debt? Or, more importantly, will the Chinese add on very many 10-year ruble denominated notes? Almost certainly not. The increase that you've seen in the gold price in the absence of any retail buying in Western Europe and North America is testimony to the fact that global central banks, reacting to the weaponization of the US dollar and not trusting each other on Monday to fulfill their obligations on Tuesday, are seeing that they have no alternative but to increase their gold holdings, both as a store of value and as a medium of exchange? I think it depends on the vault. I think a bigger risk that people face in a bull market, a bigger risk than confiscation, is entrusting gold and silver to marginal vaults. If you're going to put money in a vault, make sure that the vault is controlled by a public company where you can see their balance sheet and their income statement. Make sure that the vault is subject to an outside audit every 90 days. It is so easy for the government to steal from you via taxation, via regulation, via inflation, via quantitative easing, that they have no need to steal your bullion. A tax increase or an excise tax or printing up $2 trillion out of thin air is a kind of theft which is absolutely legal and, by the way, is always applauded by the voters. Why would Congress subject themselves to the ire of a populace that has 400 million guns in private holdings when they could steal much more very easily in a way that's very popular with the voters?
Market manipulation in the gold and silver markets has been a long-standing concern, with notable figures like RickRule pointing out the challenges such activities pose. One of the key observations is the significant difference between futures trading volume and physical delivery, indicating the potential for undue influence on market prices. Banks, through sizable short or long positions, can exert considerable sway over precious metal prices, often at the expense of smaller market participants. Regulatory bodies like the London Bullion Market Association endeavor to oversee and ensure fairness in these markets. However, the opacity of some transactions presents challenges in fully curbing manipulative activities. RickRule emphasized that organized entities around major international banks are suspected of engaging in such practices, further complicating the regulatory landscape. The CFTC has fined banks for manipulative activities, highlighting the seriousness of market manipulation, especially in precious metals markets like those involving J.P. Morgan Chase. Let's get back to the interview.
They've been patient for the last 12 years. They've been rewarded. I look back and I began to materially increase my own holdings of gold in 1998, 2 years too quick. But if we go 2000 to 2024, we see a move in the gold price from $250 to $2,100. 8.6, 8.7% compounded a year for 24 years. I would ask investors who complain about that to give their head a shake. Gold has done precisely what I asked it to do. It's maintained my purchasing power. So when the gentleman says he's being patient, I need to say, really? What were your expectations? I'm not one of those who believes in any ongoing multi-decade manipulation. I believe that lower real and marginal gold and silver prices over 40 years had more to do with the strength of the U.S. dollar and the perception, at least, that savers were enjoying real interest yields on U.S. dollar denominated deposits than anything else. Why would you bother manipulating something that was going lower? Why would you try to suppress something that was falling of its own volition? I believe that the outlook changed in 2022 when what I believe was the real rate of inflation began to substantially exceed the yield available on U.S. dollar denominated instruments at the same time that the risk associated with those instruments increased. I note that in the period 1967 to 1972, the circumstance was the same and the market didn't care. But after 5 years, when the market did care, it cared in earnest. Now, as a follow-on with regards to manipulation, all markets are manipulated in the near term, gold being no exception. Markets as big as the LIBOR market and the U.S. Treasury market are manipulated in the very near term. And they are always manipulated in the direction that it is the easiest for the manipulators to manipulate. When gold markets begin to rise, it will be easier to manipulate those markets up, which occurred in my memory in the 1970s. For the last 40 years, the easy way to manipulate them is down. When you have a market, and I think we've talked about this before, Dunnigan, where the futures market is so much larger than the physical market, the temptation to short-term manipulation is particularly intense. It is not uncommon for the silver futures markets to trade 200 times the volume of silver available for good delivery in a day. So a manipulator could establish a short ladder if he or she expected the silver price to be more likely to decline, a short ladder involving $1 billion or $1.5 billion in stages from 3 months out to 2 years, and then borrow a fair amount of physical, which they dumped in the overnight market when the volume's the least and where the damage they could do was the most, and then enjoy the change that they had affected in the spot market and its outsized impact in the futures market. And I think that happens probably on a quarterly basis. There's no other explanation for very large selling of gold and silver in the overnight markets when the volumes are the skinniest. A rational seller would be trying to maximize his or her yield on sale. In this particular instance, whoever the seller is trying to maximize their impact in the futures market. I would suggest that this is not the Trilateral Commission or the International Jewish Conspiracy or the Fed. I would suspect that these are organized cabals around the trading desks of major international banks, the same people who manipulated the Treasury market, the same people who manipulated the LIBOR market, the same people who manipulated the euro-dollar market.
On Tuesday, the gold price attracted sellers, halting the modest bounce from the $2,145 zone seen the previous day and maintaining a one-week low. What are your thoughts on the recent fluctuations in gold prices and their implications for global investors amid economic uncertainties and currency volatility? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.